Hello, I am John Najarian, and Rebelcon 2022 is almost here. We do have a virtual pass. The virtual pass gives you full access to everything, all the streams, the live trading sessions, all of our fabulous keynote speakers. So to learn more about what's going on at Rebelcon 2022, whether you're in person or virtual, check out marketrebellion.com/Dallas.
Good afternoon, Market Rebels, and happy Friday, everyone. At least as happy as it can be with the SPY being down about 3%. At least that's what I saw a little bit ago. Kind of took out those bounces off the 1,000-day moving average. Kind of puts us back at square one, but more volatility, so we'll have to see what's in store for next week. Now, as promised, yesterday I talked about a little economics puzzle that I was going to answer today. I gave you a little hint of it yesterday. And so hopefully you thought about it. But the puzzle is, give you the tagline right here, is ship the good oranges out. And this comes to us from a famous economist named Armin Alshin from UCLA, who noticed, he actually did it with apples, and he noticed that where he was from that they were producing these apples, and yet the local apples weren't all that good. But when you went to visit places where they would export to, they had these fabulous, just huge, perfect apples. And he thought, well, why are they shipping all of the good ones out? We have the same thing here in Florida. And so it's a little bit of an economics puzzle, and I'm going to show you how it relates to options trading at the end. But for right now, let's take a look at the puzzle, talking about shipping the good oranges out, and why is that? So remember that the premise was this, that let's say in Florida we have, let's say, two basic categories of oranges. We might call them high quality and low quality. So when it comes time to exporting, the question is, which do you ship out? Do you ship out the good ones, or do you ship out the bad ones, or do you mix them up? So again, it's kind of one of these puzzles that most people would never think twice of, but it's something that economists think about a lot. Any type of social interactions and consumer choice, why would the shippers, the growers, ship out the good ones? And so that's what they discovered, is that all of the good ones were being shipped out. And so that was kind of a big puzzle. And they thought, well, obviously they have a reason for doing it. It's up to us to figure out what that reason is. So hopefully, I know I gave you a little hint about that yesterday and you thought about it. Really only one of two choices. You either ship the good ones or you ship the low quality ones out. So probably half of you got that part right. But the more important question is why? Why do they ship the good quality oranges out? And here's the answer. Let's say that we have high quality oranges, and it doesn't matter. We just pick a number. We'll say that they sell for $10 a bag. And we have low quality that, say, maybe sells for $5. Now, again, it doesn't matter what numbers we choose. Now, in terms of economics, economists never look at things in terms of price. We always look at things in terms of opportunity costs. So in this case, if you can buy a high quality for 10 or a low quality for 5, we would say that the cost of a high in terms of low is 2. In other words, if you buy a high bag, you are really giving up 2 low quality bags. That's what you could have done with that money. So we just see it as 2. This is the opportunity cost. Now, we can look at the flip side of it and say, what about the low in terms of high? The low in terms of high is a half. That just means that if you choose to buy a low quality bag, you are really giving up a half of a high quality. Okay, and that's what the opportunity cost would be. But now here's where it gets interesting. If you're going to ship out the oranges, UPS, let's say, doesn't care about the quality. They care about the weight. And so the weight probably doesn't really matter whether they're high quality or low quality. So let's say that there's a fixed shipping charge. Again, doesn't matter what the number is, just pick a number. Let's say it's $5. So notice what happens now when the high quality, if they are shipped out, they now have a cost of 15, and the low quality have a cost of 10. And now let's go and run through the same numbers. What's the opportunity cost now? High in terms of low, after accounting for shipping, is 1.5 times. If you buy a high quality bag for 15, you are giving up 1.5 low quality bags. We could look at the low in terms of high, and it turns out to be 0.66. That's because it's 10 out of 15. But take a look at what's happening now in terms of the opportunity cost. The high in terms of low used to be 2, and it's now dropped to 1.5. So in other words, the high quality oranges are actually cheaper when we account for a fixed shipping cost. And so the orange producers say, well, let's ship them out to where we can sell more oranges. Relatively speaking, they are cheaper. But notice over here, they went from a half to 0.66. They got more expensive. So see, it doesn't make sense for them to ship those out because they are relatively more expensive. They're going to sell fewer. So that's really, it's the whole idea is that whenever you have a fixed commission or a fixed shipping charge, weighed against two different outcomes, let's say a high and a low grade maybe, other than that, kind of the same items, that the demand shifts towards the higher valued goods. That was the brilliant insight. Now, once you see that, you're going to see that you can use this as a little mental model, and it shows up in the strangest places. So, for example, when we were in Vegas, many of you have had this happen. You go to an ATM. Now, you would certainly think in Vegas that they're going to do everything they can to get cash in your pocket, right? And so you would think, well, ATM fees are probably going to be free. They want you to get the money. In fact, they would probably even have some type of a little raffle or something that you can maybe win a prize for getting money out. Not true. What do? $20. $20 is what most of these ATMs charge to get money out. And that's a little bit of a puzzler. Until I thought about it for a moment, I thought, it's the apples or the oranges all over again. Check this out. We could look at this as high and low quality, maybe for $100 versus $20. So a high dollar bill, let's call it, has 5 times the value of a low. Okay, so we might say the cost of a high in terms of low is 5. The cost of a low in terms of high is 0.2, right? 20%. But now watch what happens when we add a shipping charge, so to speak, or in this case, an ATM fee. Now it's going to cost you $120 to get out 100. It's going to cost you $40 to get out 20. And look what happens to the ratios now. Now it's gone from 5 to 3, and over here it's gone from 2 to 0.33. What does that tell you? It's cheaper to pull out hundreds. And that's exactly what Vegas wants you to do. They don't want you to say, I'm going to be responsible. I'm only going to pull out $20 so I can limit myself. They want to make that relatively very expensive. And so by changing these ratios and by putting a very high ATM fee, you could call it a shipping charge as well, it changes these ratios to now it's far more advantageous to take lots of money out. And that's what they want you to do, because once they've got the money in your pocket, we all know where it's going to go, right? Let's take a look at another example. What about vacation getaways? Being from, at least for a long time in Orlando, used to see this a lot, where vacation, let's say Disney vacations. So you might see $500 a night hotel, let's say for 10 nights. It's going to cost you $5,000. but they might also have $100 night hotels for 10 nights for $1,000. Who do they advertise to Orlando? In Orlando, they advertise the low price rooms. They don't advertise the Polynesian and the Contemporary Hotel. They advertise that over in, let's say, Australia. Why? Because we can look at the ratios again. High in terms of low is 5-fold. Low in terms of high is 0.2. But watch what happens when we add a very expensive shipping charge, or an airfare, you can call it. Let's say it's $3,000 to get here. Look what it does to the ratios. Now it's going to cost you $8,000 versus $4,000. High in terms of low is 2. I'm sorry, it should be low in terms of high, should be 1/2. So notice it has gotten relatively cheaper for people who have to pay very high airfares to get here. It changes those ratios. They are far more likely to buy the high-cost hotels. And yet you're not going to see that from people who live in Orlando. And this is exactly why. So it's kind of interesting when you learn to see things like this in terms of opportunity costs. But what does this have to do with options trading? Well, it's the same thing with commissions. Traders like to sell these far out of the money options, but they pay the same fixed commissions. And they seem to forget that. And after accounting for fixed commissions, higher cost options become relatively more attractive to trade. But traders don't do that. They want to sell these far out of the money things for 5 cents and 10 cents, pay relatively high commissions, and have a huge obligation, a liability, and get no money for it. If anything, you should probably be buying these because at least you're buying the tail. But it's something that I think is an important piece to understand, that when you have fixed commissions, which most brokers charge, the decision starts swinging greatly in favor of the higher valued options. Now, when you start selling these out of the money options, you've also got normalized Vega risk, which I've talked about before. You've got tail risk, which I've talked about before. And now you know a third one, which we could actually call a commission risk. So I hope that helps, gives you some things to think about. And as always, we'd like to extend a free 30-minute one-on-one coaching assessment with one of our world-class coaches. Phone number there is 888-809-8058. Give them a call. They'd be happy to set you up with a free appointment and can definitely help you to make better decisions. And that's what it's all about. So I hope that helps. I want to wish everybody a great weekend, and we'll look for you next Monday, Thursday, and Friday at 4 p.m. Eastern for more Trading Tune-Up. We'll see you then.